This video is going to talk about the economic effects of a commodity tax, a tax that we're going to place on a good that's being sold in the market. So this is a video for Chapter 5, the second half of Chapter 5. Now, in Chapter 3, when we were talking about determinants of the demand curve and determinants of the supply curve, we said that if we had one of the things that could shift the supply curve would be a tax that the producers of the goods had to pay. So that's what we're going to take into account. We're going to look at this. We're going to bring in and use this framework to analyze the effect of a tax. So what we're going to do is think of a case where there's no tax on this good, and now we're going to put a tax on the good. Now, since the tax will cause the supply curve to shift, and it would shift to the left because the supply will be reduced by the tax, then what we can do is we can look at the equilibrium before the tax is in place and compare it to the equilibrium with the tax in place. And that's what we would say, that's the comparison we're going to use to say what are the economic impacts or what are the economic effects of the tax. How does a tax affect or change the equilibrium in the market? And so that gives us a way then to actually break this down and be very specific about it. So the legal incidence is on the producers. That means that if we're talking about a tax on say, gasoline, where the gas stations sell gasoline, and then they're responsible to turn the amount of the tax over to the government. So if they have to pay 50 cents per gallon in terms of a tax, then they have to keep records for all the gallons of gasoline that they sell, and they have to send a payment to the government equal to 50 cents for every gallon that they produce, or that they sell. So if they sell 2,000 gallons of gasoline, they've got to send a check to the government for $1,000. So we'll talk about, that's what we'll call as a legal instance. That's legally who's responsible for paying the tax. Another way to think of that, if the tax doesn't get paid, who does the government come after to arrest or punish for not paying the tax? And so and that's what we'll mean by this. There is the possibility that the legal instance could be on the buyers of the tax, and the buyers would be required to send it. That'd be a different way. We'd have to shift the demand curve for that. So what we're looking here is legal incidences on the sellers. And we said the tax causes the supply curve to shift to the left. It's a decrease in supply. Now, we have to be careful, or we have to exert concern here to shift shift the supply curve the right amount. We want to shift it the right amount so that it shifts by the amount of the tax. Well, the price is on the vertical axis, and price is denominated in dollars. So if we think of a tax and it's denominated in terms of like 50 cents a gallon or $1 per gallon of milk or something like that, you think of a tax of that nature. If it's denominated in dollars, then we can read the amount of the tax off the vertical axis. And so that means we want to shift the supply curve left because a tax is going to reduce the supply. But we want to keep shifting the supply curve left until the vertical distance between the initial supply curve and our new supply curve is equal to the amount of the tax. Now, we just sort of have an arbitrary amount of tax. So all I had to do here is draw two supply curves and say that they've, that was the amount of the tax. Now, one thing to note is that I've tried to draw these two supply curves. They're both linear. They don't have to be, but linear demand and supply curves are easiest to draw and easiest to look at the diagram. So unless we have a good reason to draw it as something else, we'll draw a linear. And I've drawn the shift so that these supply curves are parallel. So the vertical distance between these two supply curves is always the same. So what that would mean is that's what's known as a specific tax. It'd be a tax, like I said, 50 cents per gallon of gasoline. So what that would mean is that when the price of gasoline is low, you're adding 50 cents on it. But when the price of gasoline is higher, then you're adding that same 50 cents still onto the supply curve. If you have a percentage tax, you'd have to draw the diagram a little differently. A percentage tax, if the tax is, say, like the sales tax, say 9% of the sales price, then what that means is that if you're selling gas or you're selling groceries at a higher price, the tax automatically goes up because it's denominated in terms of as a percentage of the price. And that would mean when you have a percentage here, the supply curve would be shifting in a not parallel fashion. You'd have a larger shift up here than you would down here. But so we're drawing, in a sense, visually the simplest case where the supply curve is shifting by a constant amount. And again, that's what's known as a specific tax. Okay, so we have our initial supply curve. We have our second supply curve I labeled here S plus tax, just to remind us, it's not just S2. That's the supply curve with the tax on it. And we have two equilibrium. We have an equilibrium here where where S1 was intersecting the demand curve. That's the pre-tax equilibrium. And then we have the equilibrium here where the supply curve with the tax intersects the demand curve. So we'll have a new equilibrium when we want to compare these two equilibria. So Q1 and Q2 are the different the equilibrium quantities. We can see that the quantity is less. You tax the good, the equilibrium quantity with the tax in place is going to be less than the initial quantity. They're all saying if you tax anything, you get less of it. So that we see that here. We know that the vertical distance between the two supply curves are the amount of the tax. And I've come over here and I've labeled these two prices, PC and PS. We would initially have said, if it was back in chapter 3 and we just shifted the supply curve, we'd say, oh, well, this is the new equilibrium price, and I could have labeled it P2. But I labeled it PC here because that's going to be the price that consumers pay for the good. And then I have this labeled as PS. PS, we get PS by taking Q2 here, the equilibrium quantity, where the supply and demand intersect with the supply curve, with the tax on the good. And we consider this vertical line here, and where it intersects the original supply curve, that's where we're getting PS from. That's the, in effect, at Q2, that's the height of the initial supply curve. Why do we want to do that? Well, at Q2, producers receive the price P1, PC from consumers. That's how much consumers are paying for gas or milk or whatever the good is here. And then the suppliers have to take the tax out. When they take the tax out and send that payment to the government, they're left over with this amount PS. And so that's what we're going to call the PS is the price that suppliers receive. It's the amount that they get to keep out of sales of the good. And one way to think about this here is in this market with the tax in place, if you ask consumers, how much does the good cost, they would say it's PC. If you ask the producers, the suppliers, how much are you receiving for the good, they would say, oh, that's PS, because that's how much they get to keep. And one way to think about it is PS, we can think of getting PS off the initial supply curve S1, because we say at a price of PS with the supply curve S1, the suppliers were willing to supply this quantity, Q2, that's the amount that they wanted to supply. And at Q2, off of the demand curve, we say at a price of PC, that's the price at which consumers would want to purchase Q2 units. So PC and PS are the prices that consumers are going to pay, and then a price that suppliers get to keep. And again, that vertical distance, that distance between them is the tax. Now, is the amount of the tax per unit. Now, if you want to talk about how much revenue does this tax raise, well, the tax revenue is going to be the amount of the tax times the amount of units that the tax that get sold with the tax that the tax gets applied to, and that's Q2. So, and I have it up here. It's going to be in purple. I'm now going to draw the rectangle, the shade in the rectangle. That's going to be for the revenue. So here's the tax revenue. And one thing to note here is that the revenue that's going to be collected from this tax is based on Q2, not Q1. So if you're looking at this market before the tax is put in place and you're trying to estimate how much revenue is going to be collected from this tax, you might be looking at the quantity of gas or milk that was being sold before the tax was in place and think, oh, we impose a tax, the tax times Q1 is going to give us the revenue. That's not correct. It's you're only going to collect that revenue on the units that get sold, and that's Q2. So The tax revenue is based on Q2. If before you put this tax in place or you're thinking about raising a tax, you have to be trying to estimate how much of this good is actually going to get produced and sold with the tax in place. And it will be less, because I said if you tax anything, get less of it, it will be less than the initial amount. We have another effect here, and that's going to be a deadweight loss. We said it in a video from the first part of chapter 5, talk about efficiency, that we know that Q1 is the efficient quantity of this good. Now, we put a tax on, we shifted the supply curve, and so that's sort of like the cost of producing this good going up. But then again, the cost of producing this good hasn't really gone up, because all we've done is that the government's come in and say, no, you have to charge a tax on this. So the efficient quantity of this good remains Q1, because this shifting of the supply curve over is in a sense sort of artificial, or being created by the government. So the units between Q2 and Q1 do not get produced and sold with the tax in place. Those units were producing producer and consumer surplus when they were produced in the pre-tax equilibrium. So we lose that, and therefore those units don't get produced, therefore we can't get any surplus on that, and so therefore the producer and consumer surplus that would have been captured from that is now lost, and that's lost and it's not captured by anyone else. So we'll call this deadweight loss. So the label it. And if the demand and supply curves are both linear, then this deadweight loss area will be a triangle. Now we can do one more thing. PC and PS are the prices that the consumers are paying and suppliers are receiving with the tax in place. That gives us a way to talk rigorously, and economists would say correctly, about who really pays the tax. And what we can say is that PC minus P1, if you look at the price that consumers pay, compared to the pre-tax equilibrium price, that's the portion of the tax that consumers would pay. P1 minus PS, that's the portion of the tax that the suppliers are paying, because suppliers end up receiving a lower price. They were previously selling this good for P1. Now with the tax in place, they only get to keep PS after after they pay the tax. So they're receiving a lower price. Consumers are paying a higher price. We can use these differences here to talk about what proportion of the tax consumers and producers are both paying. Well, we have one important result here, because we said the legal incidence is on the sellers in this case. So if we said that 100% of this tax is legally paid by the producers. But what we can see here is that this, when we compare the equilibrium, a portion of the tax is going to be paid by consumers, and a portion of the tax is going to be paid by suppliers. So in other words, suppliers were able to, in fact, shift a part of the tax, the burden of this tax, to consumers. Not all of it. You might think like, oh, if you put a 50-cent per gallon tax on gasoline, suppliers will just pass that on. And if the price of gasoline previously was $3 and now you add 50 cents on it, the equilibrium price will be $3.50. Suppliers will just pass it on. In one sense, they do, because the shifting of the supply curve is showing that to supply any given quantity of gas, they would now need to receive 50 cents more per gallon than they would have before. That's what the shifting of the supply curve shows. But equilibrium does not go up from here to here. It does not go up by the equilibrium price does not go up by the full amount of the tax. It only goes up by an intermediate amount because of the shape of the demand curves and the supply curves. And so what we can see is that a portion of this tax gets shifted. We would say that it is shifted to the consumers. The legal incidence is 100% on the suppliers, but the economic incidence, what we're talking about here, based on comparing the equilibrium, the economic incidence is shared. So we have some tax shifting going on, but the suppliers cannot arbitrarily pass all of the tax onto the consumers. It ends up being shared, and that's sort of the general case. So there we have it, those are the economic effects of a tax, and we get that by comparing the equilibrium without a tax to the equilibrium in the market with a tax.